So the why now question has been a question that is obviously high up on every investor's mind. We have been tracking this space for over a decade, and I myself, a large part of last decade. And I would say where the market is now is in a very different space than it was 10 years ago. So if we look at the world in terms of venture growth and buyouts, and we look at US and Europe, the US had a very good 90s in terms of the venture ecosystem, and that generated a lot of great investors who were able to create big successes that became part of what is now growth equity in the 2000s. And so you had great names like Summit, TA, General Atlantic, and so on, really having a fantastic go at it over the 90s and 2000s on the back of a very successful venture industry. In Europe, we had not as many players that were able to make enough money to manage the post 2001 decline. And so we had less of a venture scene in the early 2000s that was able to feed this asset class. Over the last 15 years, though, the picture is completely different. So in Europe, we've had a phenomenal venture development over the last, particularly 12 years. So since the GFC, we've had over 100 unicorns minted. We've had tremendous exits that were recycled into the ecosystem, both in terms of money and in terms of talent. So people that exited, success stories that now started again. And so having both the capital and the talent pool to feed these success stories. And so now where we are, we have thousands of graduates of this venture scene ready to come into the market. And so this is a very opportune moment. I think the 2020s will prove to be a phenomenal time for, if we look at it backwards in the decades, this will be the decade that European growth equity has established itself as a proper asset class because of the success of European venture in the last decade. I think you have to have that. It's almost what we call the university. It's you have to go through the venture university in order to have enough graduates from that program to tap into the growth stage. And then once you've had that, then that feeds the sort of tech buyout stage and so on. So for me, it's a natural part of the evolution. And it is the result of what I think most European investors can feel very proud of, having such a great venture scene over the 2010s that has produced now hundreds and thousands of companies that are entering the growth stage. So the one thing that we start from is generating fantastic deal flow. That's our one differentiator. I would say the leading differentiator in the market is the quality, the breadth and depth of the deal flow that we get. And how do we get that deal flow? We do it working with the GP ecosystem, not in competition, but as catalytic capital for those growth rounds that need a bigger investor to come in that has experience. We've done over 230 direct deals, so we can bring a lot of experience to the table, but is also positioned as friendly capital to the GP ecosystem rather than someone that's trying to get ahead of you in a deal. So with this positioning, we're able to source an enormous amount of very interesting opportunities across the piece. And what we like to do with that is get actually quite concentrated on a thematic basis. So we source wide in terms of both countries and sizes of deals and a number of other dimensions, but we get quite thematically concentrated. And the themes that we focus on, we call it people, planet, productivity. So the people side is the revolution in healthcare and education, in particular, how people are consuming those services. On the productivity side, that's the B2B. How do you change the way that you do things from an enterprise and mid-market segment, particularly around areas like fintech, cybersecurity, e-commerce, and so on. And on the planet side, which I think is a very, very important pillar, that's the resource efficiency plays that have to do with technology. So this is not doing solar farms, which is a technology that's now very well established and really competing with real estate and very mature asset classes like that. It's the technology that enables the resource efficiency to expand dramatically. So technology-enabled people plays, technology-enabled B2B software, and the resource efficiency side of things. We focus quite a bit on these themes. So we source far and wide, we are thematically concentrated, but we like to work with a number of people, including a number of specialists in sub-sectors, so we get the best ideas from each segment. So for me, growth equity is now where private equity in general was in Europe 20 years ago. So when you look at what funds, the main players in private equity that are still around now were raising at that time in the late 90s and early 2000s, and the kinds of deals that they were doing, they were more of the size and transformational scope to the investment that growth equity is doing now. So when you look at, you look back at, what Bridgepoint and Permira were like 20 years ago, they were in a very different size bracket, and they were executing quite a lot of transformation on those companies. To me, growth equity, now that private equity is such an established asset class, and you have investments in the buyout space that go from one GP to the other, and a lot of that transformation from a family owner or a state owner or what have you, a lot of that transformation might have already taken place. I think growth equity is now at the same stage of in readiness to take sort of a really big part of private equity as we look at it over the next 10 years. So for me, it's going to be, this is a personal but high conviction play, it's going to be a very large part of private equity if we look at it 10 years from now. So the way we're looking at it as a distinct asset class, I think this asset class, which to me has very similar characteristics to what the origin of private equity was like, certainly in Europe 25 years ago, I think we will see that developing within the growth equity segment and essentially taking up a very large part of it. That's not to say that in relative terms, I'm not saying that the buyout space is not going to keep growing. I think it will keep growing, and the large cap space might still be taking a lot of share from listed markets, but that's its competition now. For the large cap space, for me, it's really comparing what's the ownership model of a public company and what's the ownership under a large cap private equity firm like, and what are the pros and cons from an investment perspective in that sense. But what private equity used to do, which is this expansion, capital, professionalization play, really bring the company from a small lifestyle business or from a relatively young player in the market to the next level where it's an established player in the market, that space, that's taken up by growth equity now. So I think that's what I see for the next 10 years, both in Europe and across the world.